100 Most Important Things to Know About Money. Sopians, MD. Understanding these 100 key concepts, principles, and practical tips about money will help you make informed financial decisions, achieve your financial goals, and build a secure financial future. Introduction. In a world driven by dreams, desires, and aspirations, one thing remains steadfast and undeniable in its influence: money. The pursuit of financial wisdom is an endeavor that transcends borders, cultures, and generations. This is because the language of wealth is universal. Our lives are intricately woven with the threads of fiscal choices, investment decisions, and the pursuit of economic freedom. It is the enabler of dreams, the source of security, and the key to unlocking the doors of our desires. In the pages of this book, 100 Most Important Things to Know About Money, I will share with you some financial stuffs and fundamental principles that govern the world of wealth. From saving and investing to understanding the nuances of debt, taxes, and retirement planning, this book serves as your compass on the path to financial empowerment. I love what Oscar Wilde said about money. He said, "When I was young, I thought that money was the most important thing in life. Now that I am old, I know that it is." That's absolutely true. It means the value and importance of money never gets old, even though we get old. Money will still be very important and a yardstick to measure the level of individuals' success and achievement in life. In this book, you'll find insights that transcend mere numbers. You will learn things that will stick with you for the rest of your life. For money is not just a medium of exchange, but a powerful tool for shaping your future and achieving your aspirations. The knowledge contained herein is a gift, a treasure trove of wisdom handed down through the ages and distilled into these 100 essential truths. It's a roadmap that guides you toward financial independence, a compass that keeps you on course in the turbulent seas of economic uncertainty. Whether you're a seasoned financial expert or just setting foot on the path to prosperity, 100 Most Important Things to Know About Money is your companion, illuminating the way forward and empowering you to make informed, strategic decisions. It reminds you that wealth is not merely about accumulating, but also about securing and growing, a means to a life well lived. So, open these pages and embark on a journey toward financial mastery. For in understanding money, you unlock the door to a life of freedom and limitless possibilities. 1. Paying yourself first involves saving before spending. Think of your savings as a non-negotiable expense, just like paying your bills. By saving a portion of your income before you spend it, you prioritize your financial future. This approach ensures you consistently set aside money for your goals and emergencies, preventing overspending and promoting long-term financial security. 2. Money is a medium of exchange used for goods and services. Money serves as a universal tool that simplifies trade. It represents value and allows people to exchange products and services efficiently. Understanding this fundamental truth about money is crucial for participating in the modern economy, as it enables you to buy and sell goods and services. 3. Understanding the value of money is essential for sound financial management. Recognizing that money is a limited resource and that each expenditure affects your overall financial well-being is fundamental. It involves making informed choices about how to use your money wisely, ensuring that your spending aligns with your priorities and goals. 4. Budgeting is the foundation of financial control, helping you track income and expenses. A budget is your financial roadmap. It provides a clear picture of your income and how you allocate it to various expenses. By tracking your spending and ensuring it doesn't exceed your earnings, you gain control over your finances, avoid overspending, and work toward your financial goals. An emergency fund is crucial for unexpected expenses or financial emergencies. Life is unpredictable, and unexpected expenses can arise at any time. An emergency fund is a dedicated savings account that provides a financial safety net. It ensures you have money set aside to cover unforeseen events like medical bills, car repairs, or job loss, preventing financial hardship. 6. Financial literacy is the key to making informed financial decisions. Financial literacy involves understanding essential financial concepts, such as budgeting, investing, and managing debt. By educating yourself about these topics, you can make informed decisions that lead to better financial outcomes and security. 7. Credit scores affect your ability to borrow money and the interest rates you receive. Credit scores are numeric representations of your creditworthiness. They influence your ability to secure loans, credit cards, or mortgages. A higher credit score can lead to more favorable lending terms, including lower interest rates. 8. Debt, when managed wisely, can be a useful financial tool. Debt can help you achieve significant goals, such as buying a home or funding education. When managed responsibly, it allows you to access capital without depleting your savings. However, it's crucial to use debt judiciously and have a plan for repayment. 9. Interest rates impact borrowing costs and the return on savings. Interest rates affect both the cost of borrowing and the earnings on your savings. High interest rates can make borrowing more expensive but also lead to higher returns on savings and investments. Inflation erodes the purchasing power of money over time. Inflation is the gradual increase in prices over time. It means that the same amount of money buys less in the future. Understanding inflation underscores the importance of investing and saving to preserve your purchasing power. 11. Saving is essential for achieving short-term and long-term financial goals. Saving is the act of setting aside money for specific purposes. Whether you're saving for a vacation, a home, or retirement, it is a fundamental step in achieving your financial goals, both immediate and distant. 12. Diversification reduces risk by spreading investments across various assets. Diversification involves spreading your investments across different asset classes, such as stocks, bonds, and real estate. It reduces risk because losses in one asset may be offset by gains in another, leading to a more balanced portfolio. 13. Compound interest allows your money to grow over time. Compound interest is the phenomenon where your money earns interest, and that interest in turn earns more interest. It accelerates the growth of your investments, particularly over longer periods, and is a powerful wealth-building tool. 14. Risk is inherent in investing. Assess your risk tolerance. All investments carry some level of risk. To make informed investment choices, it's crucial to understand your risk tolerance, or how much risk you are comfortable with. A risk assessment helps align your investments with your financial goals and risk comfort level. 15. A well-defined investment strategy aligns with your financial goals. Your investment strategy should be tailored to your financial objectives, whether it's retirement, education funding, or wealth accumulation. A clear plan guides your investment decisions and helps you stay on track. 16. The time value of money emphasizes the importance of saving and investing early. The concept of the time value of money underscores that money has greater value when received or invested sooner. This principle encourages early saving and investing to maximize long-term financial growth. 17. Tax-efficient investing minimizes tax liabilities on investment gains. Tax-efficient investing involves strategies to reduce the impact of taxes on your investment returns. It's essential for optimizing your after-tax gains and minimizing your tax liabilities. 18. Asset allocation balances risk and return in your investment portfolio. Asset allocation involves determining the mix of assets in your investment portfolio. The goal is to balance risk and return according to your financial objectives and risk tolerance. 19. Retirement planning is vital for financial security in later years. Planning for retirement is crucial to ensure you have the financial resources needed for a comfortable and secure life after you stop working. It involves saving, investing, and considering factors like Social Security and pensions. Dollar cost averaging involves regular, fixed investments, regardless of market conditions. Dollar cost averaging is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. This approach helps reduce the impact of market volatility and promotes disciplined investing. Investment fees can significantly impact your overall returns. When you invest, there are often fees associated with managing your investments, such as management fees, transaction costs, and fund expenses. Over time, these fees can add up and eat into your returns. It's essential to be mindful of investment costs, as even seemingly small fees can have a substantial impact on the growth of your investments. A checking account is used for daily expenses and payments. A checking account is a bank account designed for everyday financial transactions. It allows you to deposit money, write checks, use a debit card, and make electronic payments. Checking accounts are ideal for managing your daily expenses, paying bills, and having easy access to your funds. 23. A savings account is for short-term savings and emergencies. A savings account is a bank account specifically meant for storing and saving money. It offers a safe place to keep funds, earn interest, and access cash when needed. People use savings accounts to build short-term savings for goals like vacations or emergencies, where the money is readily available. Certificates of deposit offer higher interest rates but with restricted access. Certificates of deposit are savings instruments offered by banks with higher interest rates than regular savings accounts. However, they come with a catch. Your money is locked in for a specific term, typically ranging from a few months to several years. Withdrawing the money before the CD matures may result in penalties, but you earn more interest compared to a standard savings account. 25. Credit unions provide similar services to banks but are member-owned. Credit unions are financial institutions that offer services similar to traditional banks, such as savings accounts, loans, and checking accounts. The key difference is that credit unions are member-owned, meaning customers often have a say in the institution's governance. Credit unions may also offer competitive interest rates and lower fees. 26. Credit cards allow for convenience but come with interest if not paid off in full. Credit cards provide a convenient way to make purchases, but they operate on a credit basis. When you use a credit card, you're essentially borrowing money. If you carry a balance from one month to the next, you'll be charged interest. To avoid interest charges, it's crucial to pay off your credit card balances in full each month. 27. Mortgages are loans for buying a home, often repaid over 15 or 30 years. Mortgages are long-term loans used to purchase homes. They come in various forms, with the most common options being 15-year and 30-year terms. Mortgages allow individuals to buy homes with a down payment and pay off the loan gradually through monthly installments, which include both principal and interest. 28. Personal loans are used for various purposes and typically have fixed terms. Personal loans are unsecured loans that can be used for a variety of purposes, such as consolidating debt, covering medical expenses, or making home improvements. They typically have fixed terms, meaning you repay the loan over a specific period, and they do not require collateral. 29. Auto loans finance the purchase of vehicles with fixed monthly payments. Auto loans are loans specifically designed to help individuals buy vehicles. They involve borrowing money for a car purchase and repaying the loan with fixed monthly payments. The terms of auto loans can vary, but they often span several years. 30. Student loans help fund education but may lead to substantial debt. Student loans are loans used to finance educational expenses, including tuition, books, and living costs. They can be essential for obtaining a degree, but may result in significant debt. It's important for students and their families to understand the terms of the loans and explore repayment options. Insurance, including health, auto, and life insurance, protects against financial risks. Insurance is a financial product that provides protection against various risks. Health insurance covers medical expenses. Auto insurance protects against vehicle-related incidents, and life insurance provides a financial safety net for loved ones in the event of a policyholder's death. Insurance policies require regular premiums for coverage. A good credit score is essential for favorable loan terms and interest rates. Your credit score is a numeric representation of your creditworthiness. Lenders use it to assess the risk of lending to you. A high credit score typically results in more favorable loan terms, lower interest rates, and easier access to credit. It's essential to maintain good credit by managing your debts responsibly. Paying bills on time is crucial for maintaining a positive credit history. Paying your bills on time is a fundamental aspect of good financial management. Consistently making timely payments, including credit card bills, loans, and utility bills, helps build and maintain a positive credit history. A positive credit history contributes to a higher credit score. 34. High interest debt, such as credit card debt, should be paid down quickly. High interest debt, like credit card debt, can be expensive to carry. The interest charges add up, making it challenging to get out of debt. It's essential to prioritize paying down high interest debts quickly to avoid unnecessary financial costs. 35. Avoiding excessive debt and living within your means is key to financial stability. Living within your means involves spending less than you earn and avoiding excessive debt. This financial principle promotes stability, reduces financial stress, and enables you to build a strong financial foundation. 36. Student loans can be manageable with various repayment options and forgiveness programs. While student loans can lead to substantial debt, various repayment options are available, including income-driven repayment plans and loan forgiveness programs. Understanding these options can make managing student loan debt more manageable. 37. Debt consolidation may help simplify payments but doesn't necessarily reduce the debt. Debt consolidation involves combining multiple debts into a single loan or credit card. While it may simplify payments and lower interest rates, it doesn't reduce the total amount of debt owed. It's essential to manage the consolidated debt responsibly to achieve financial relief. 38. Negotiating with creditors is an option for those facing financial hardship. When facing financial difficulties, it's possible to negotiate with creditors to modify the terms of your loans or debts. Creditors may agree to lower interest rates, extend payment terms, or provide other concessions to help you manage your financial challenges. 39. Credit counseling services can assist with debt management and budgeting. Credit counseling services offer professional guidance for individuals struggling with debt. They can help create budgets, negotiate with creditors, and explore debt management strategies to regain financial stability. Bankruptcy is a legal option to manage overwhelming debt, but has long-term consequences. Bankruptcy is a legal process that can help individuals overwhelmed by debt find relief. While it offers a fresh financial start, it also has long-term consequences, such as impacting your credit score and financial future. Bankruptcy should be considered as a last resort after exploring other options. Building and maintaining a good credit history takes time and responsible financial behavior. Establishing a positive credit history involves consistently managing credit accounts, making on-time payments, and using credit responsibly. This process takes time and effort, but it's essential for obtaining favorable loan terms and credit opportunities in the future. Retirement accounts, like S, provide tax advantages for long-term savings. Retirement accounts, such as S, offer tax advantages to encourage long-term savings. Contributions to these accounts are often tax-deductible, and the growth within the account is tax-deferred until retirement, making them powerful tools for building a retirement nest egg. 43. IRAs offer additional tax-advantaged retirement savings options. IRAs are personal retirement savings accounts that also provide tax benefits. They come in two primary forms: traditional IRAs and Roth IRAs. These accounts allow individuals to save for retirement while enjoying various tax advantages. 44%. Roth IRAs provide tax-free withdrawals in retirement. Roth IRAs offer tax-free withdrawals in retirement. While contributions to Roth IRAs are not tax-deductible, the earnings grow tax-free, and withdrawals in retirement are tax-free, making them an attractive choice for long-term savings. 45. Traditional IRAs offer tax benefits upfront and tax-deferred growth. Traditional IRAs provide immediate tax benefits, as contributions are often tax-deductible. The money within the account grows tax-deferred, meaning you don't pay taxes on it until you withdraw the funds in retirement. 46. Social Security provides a financial safety net for retirees. Social Security is a government program that provides income to eligible retirees. It serves as a financial safety net, offering a source of income to help cover basic living expenses during retirement. 47. Pension plans offer retirement income for some employees. Pension plans offered by some employers provide retired employees with regular income payments. These payments are typically based on years of service and salary. Pensions can be an essential part of retirement income for those who have access to them. 48. Long-term care insurance can protect against the high costs of healthcare in retirement. Long-term care insurance is designed to cover the expenses associated with extended healthcare needs, such as nursing home care or in-home assistance. It helps protect your retirement savings from the potentially high costs of long-term care. 49. A well-structured retirement plan should include a diversified portfolio. Diversification is a key principle of retirement planning. A diversified portfolio includes a mix of different investments such as stocks, bonds, and real estate to help manage risk and optimize returns over time. 50%. Regular contributions to retirement accounts help build savings over time. Consistently contributing to retirement accounts, such as 401 seconds or IRAs, is crucial for building a substantial retirement nest egg. Regular contributions, especially when started early, benefit from compound growth and accumulate wealth over time. 51. Creating a retirement budget is essential for managing expenses in retirement. A retirement budget outlines your expected expenses and income during retirement. It helps you plan for a comfortable retirement by ensuring you have enough funds to cover living expenses, health care, travel, and leisure activities. Mortgages come with various terms, including fixed rate and adjustable rate options. Mortgages are loans for buying homes and come in different forms. Fixed rate mortgages have constant interest rates, while adjustable rate mortgages have variable rates that can change over time. Choosing the right type depends on your financial situation and preferences. 53. Homeownership requires a down payment, typically 20% of the purchase price. When buying a home, a down payment is an upfront payment made to secure the property. A standard down payment is often 20% of the purchase price, although lower down payment options are available with certain loans. 54. Property taxes, insurance, and maintenance are ongoing costs of homeownership. Owning a home involves additional expenses beyond the mortgage, including property taxes, homeowners insurance, and maintenance costs. It's important to budget for these ongoing expenses to ensure you can comfortably afford homeownership. 55. Home equity is the value of your home minus the mortgage balance. Home equity represents the portion of your home's value that you own outright. It's the difference between your home's market value and the remaining mortgage balance. Building home equity is an important aspect of homeownership. 56. A mortgage pre-approval can help you determine your home buying budget. Obtaining a mortgage pre-approval involves a lender evaluating your financial situation and creditworthiness to determine how much you can borrow for a home. Purchase. It helps you set a realistic budget and demonstrates your seriousness to sellers. 57. Real estate can be an investment through rental properties and property appreciation. Real estate investment can involve purchasing properties for rental income or capitalizing on property appreciation. It's a way to diversify your investment portfolio and potentially generate passive income. 58. Location and market conditions influence real estate values. The location of a property and market conditions significantly impact its value. Desirable areas and strong housing markets can lead to property appreciation, while less favorable conditions may result in slower growth. Renting can be a more flexible housing option for some individuals. Renting offers flexibility in terms of housing, allowing individuals to relocate more easily. It may be a preferable option for those who want to avoid the responsibilities of homeownership or have changing living circumstances. 60. A home inspection is critical when buying a property to assess its condition. Before purchasing a home, it's essential to have a professional home inspection. This assessment helps identify potential issues or needed repairs, ensuring you make an informed decision and negotiate with a seller if necessary. 61. Real estate investments require thorough research and due diligence. Before investing in real estate, it's crucial to conduct extensive research and due diligence. This includes assessing the property's location, market trends, potential rental income, and any necessary repairs. Thorough research helps mitigate risks and makes for informed investment decisions. 62. Tax planning can minimize your tax liability through deductions and credits. Tax planning involves strategically organizing your finances to minimize tax liabilities. It includes taking advantage of deductions, tax credits, and legal tax avoidance strategies to ensure you pay the least amount of taxes required by law. 63%. Capital gains tax is applied to profits from selling investments. Capital gains tax is a tax on the profit made from the sale of investments like stocks, real estate, or other assets. The tax rate can vary based on factors such as the holding period and your income. 64%. Estate taxes may apply to the transfer of assets upon death. Estate taxes are levied on the transfer of a deceased person's assets to their heirs. These taxes are often based on the total value of the estate and may have exemptions or deductions depending on the current tax laws. 65. Tax-advantaged accounts like HSAs and 529 plans offer specific benefits. Tax-advantaged accounts, such as health savings accounts for medical expenses and 529 plans for education savings, provide specific tax benefits. Contributions to these accounts may be tax-deductible, and withdrawals for qualified expenses are often tax-free. 66. Tax-efficient investing minimizes the impact of taxes on investment returns. Tax-efficient investing involves strategies to reduce the tax impact on investment returns. This may include holding investments for the long term, minimizing capital gains, and considering tax-efficient investment vehicles. 67. Charitable contributions can result in tax deductions. When you make charitable donations, you may be eligible for tax deductions. These deductions can reduce your taxable income and consequently your tax liability. Keep records of your charitable contributions to claim these deductions. 68. Professional tax advice may be necessary for complex tax situations. Complex tax situations, such as those involving business ownership, multiple investments, or international income, may require the expertise of a tax professional. Tax advisors can provide guidance and help optimize your tax strategy. 69. The tax code changes, so it's important to stay informed about tax laws. Tax laws are subject to change through legislation and reforms. It's essential to stay informed about these changes, as they can impact your tax obligations and financial planning. Keeping up to date with tax laws is crucial for compliance and financial optimization. 70%. Tax returns must be filed annually, and deadlines should not be missed. Filing tax returns annually is a legal requirement. Missing deadlines can result in penalties and interest charges. It's essential to file your taxes accurately and on time to avoid financial consequences. 71. Financial planning should consider the tax implications of various decisions. When making financial decisions, it's important to consider the tax consequences. This includes decisions related to investments, retirement planning, estate planning, and major purchases. Strategic financial planning can help minimize taxes over the long term. 72. Stocks represent ownership in a company and can provide capital appreciation. Stocks represent ownership shares in a company. Investors purchase stocks in the hope of capital appreciation, increased value over time. Stocks can also provide income through dividends. 73. Bonds are loans to corporations or governments with interest payments. Bonds are debt instruments issued by corporations or governments to raise capital. When you buy a bond, you're essentially lending money, and in return, you receive periodic interest payments and the return of your principal investment at maturity. 74. Mutual funds pool investors' money to invest in a diversified portfolio. Mutual funds collect money from multiple investors and use it to invest in a diversified portfolio of stocks, bonds, or other assets. They offer diversification and professional management, making them a popular choice for investors. 75. Exchange-traded funds are similar to mutual funds but traded like stocks. Exchange-traded funds are investment funds that hold a basket of assets, similar to mutual funds. However, ETFs are traded on stock exchanges like individual stocks, providing liquidity and flexibility to investors. 76. Commodities include raw materials and agricultural products like gold, oil, and wheat. Commodities are physical goods, such as gold, oil, wheat, and other raw materials, that can be traded on commodity markets. They can serve as investments and are often used for diversification in portfolios. 77. Currency exchange rates determine the value of one currency relative to another. Currency exchange rates reflect the value of one currency in comparison to another. These rates fluctuate based on economic factors and market conditions, affecting international trade and currency investments. 78. Dividends are regular payments to shareholders by companies. Dividends are payments made by companies to their shareholders, typically from their profits. They provide a source of income to investors who own dividend-paying stocks. 79. Understanding investment markets and trends is essential for making informed decisions. To make informed investment decisions, it's crucial to stay informed about investment markets and trends. This includes monitoring economic indicators, market news, and the performance of various asset classes. 80%. Economic indicators provide insight into the health of an economy. Economic indicators are data points that provide insight into the overall health and performance of an economy. Examples include unemployment rates, GDP growth, and consumer price indices. These indicators are closely watched by investors and policymakers to make informed economic and financial decisions. 81. Investment research, including reading financial statements and market analysis, is important for informed investing. Informed investing requires conducting research, which may involve studying a company's financial statements and analyzing market trends. This research helps you make educated investment decisions and manage risk. 82. Financial success is tied to long-term habits and consistency. Achieving financial success is not just about short-term gains. It's about establishing good financial habits and consistently following them over the long term. These habits can include saving, budgeting, and investing wisely. 83. Setting financial goals provides direction and motivation. Setting clear financial goals provides direction and motivation for your financial journey. Whether your goals are saving for a home, funding education, or retiring comfortably, they help you stay focused and measure your progress. 84. Lifestyle inflation can erode savings and investments over time. Lifestyle inflation occurs when your spending increases as your income rises. While it's natural to enjoy improved financial comfort, excessive lifestyle inflation can erode your ability to save and invest, ultimately hindering your long-term financial security. 85. A frugal lifestyle can help you save more money. Embracing a frugal lifestyle involves making conscious choices to spend less and save more. This approach can be a powerful way to increase your savings and reach your financial goals faster. 86. Building an emergency fund provides financial security. An emergency fund is a savings account designed to cover unexpected expenses like medical bills or car repairs. It provides financial security and prevents you from going into debt during emergencies. 87. Reducing high-interest debt should be a financial priority. High-interest debt, such as credit card debt, can be costly to carry. Paying it down should be a financial priority as it frees up money for savings and investments and reduces financial stress. 88. Tracking expenses is crucial for effective budgeting. Keeping track of your expenses is essential for effective budgeting. It helps you understand where your money goes, identify areas for cost cutting, and maintain financial discipline. 89. A will ensures your assets are distributed as you wish. A will is a legal document that outlines how your assets should be distributed upon your death. It ensures your wishes are followed and helps prevent disputes among heirs. Estate planning covers asset distribution, wills, and trusts. Estate planning is a comprehensive process that encompasses various elements, including wills, trusts, and the distribution of assets. It's essential for ensuring your assets are managed and passed on in accordance with your preferences. Falling for get-rich-quick schemes can lead to financial disaster. Get-rich-quick schemes often promise rapid and substantial financial gains but are typically too good to be true. Falling for such schemes can lead to financial losses and disappointment. Sound financial growth usually requires patience and prudent strategies. 92. Impulse buying can disrupt your budget and savings. Impulse buying involves making unplanned and often unnecessary purchases. It can disrupt your budget, reduce your savings, and lead to financial instability. Avoiding impulse buying is essential for responsible financial management. 93. Ignoring financial education and advice can lead to uninformed decisions. Financial education and advice provide valuable insights into managing your money effectively. Ignoring these resources can result in uninformed financial decisions that may not align with your goals. 94. Relying solely on credit can result in excessive debt. An over-reliance on credit cards and loans without responsible management can lead to excessive debt. It's important to use credit wisely and within your means to avoid financial strain. 95. Neglecting retirement planning can lead to financial difficulties in old age. Neglecting retirement planning, such as saving for retirement accounts like 401 Seconds and IRAs, can result in financial difficulties in your old age. Adequate retirement planning ensures you have the resources needed for a comfortable retirement. 96. Speculative investing without research can result in significant losses. Speculative investing involves high-risk investments with the potential for high returns. However, without thorough research and understanding of the risks, it can lead to significant financial losses. 97. Failing to create a will may lead to disputes over your assets. Failing to create a will can leave your estate without clear instructions for asset distribution. This may lead to disputes among family members and unintended consequences for your assets. 98%. Ignoring healthcare and insurance needs can be financially risky. Neglecting healthcare and insurance can lead to financial risk. Health insurance, for example, provides protection against high medical costs, while other insurance policies safeguard against unexpected events, such as accidents or property damage. 99%. Neglecting taxes and financial planning can lead to higher tax bills. Neglecting tax planning can result in missed deductions and credits, leading to higher tax bills. Effective financial planning includes strategies to minimize your tax liability within the bounds of the law. 100%. Not diversifying investments can expose you to unnecessary risk. Diversifying investments involves spreading your money across different asset classes to reduce risk. Failing to diversify can expose you to unnecessary risk if a particular investment underperforms. Diversification is a key strategy for managing investment risk. Conclusion. As we conclude our exploration of this book, we find ourselves not at the end, but at the beginning of a remarkable journey, a journey toward a life of financial empowerment, freedom, and fulfillment. The wisdom contained in these pages is not merely information. It is the fuel that propels your dreams and the compass that guides you toward the life you envision. Throughout our voyage, we've learned that money is not an end in itself, but a means to achieve a life well lived, one where you have the power to shape your destiny, secure your future, and make a positive impact on the world. We've discovered the value of saving, the art of investing, the importance of understanding debt, the intricacies of taxes, and the essence of sound retirement planning. We've seen how financial knowledge can be a bridge between aspiration and realization, transforming dreams into reality. And we've recognized that financial freedom is not a distant mirage, but a tangible destination, attainable through diligent learning, prudent decision-making, and unwavering determination. As we part ways with these 100 truths about money, remember that this knowledge is not meant to gather dust on a shelf, but to be put into action. The choices you make today will shape your financial future, and by extension, the future of those you care about. Take these lessons to heart, for they are your armor against the storms of financial uncertainty and your guiding light toward prosperity. Let this book serve as a reminder that your financial journey is a path of lifelong learning, growth, and transformation. Embrace the challenges, welcome the opportunities, And remember that your journey is unique. The pursuit of financial wisdom is not a destination, but a continuous evolution.